you avoid the capital gains and you get the tax benefit of a deduction for the charitable contribution. So the highly appreciated stocks are a great option for moving into donor advised funds.
Hi, everyone. Welcome to the Morris Financial Concepts Podcast. Today, we're talking to Tiffany Ritchie, and we're going to talk about charitable gifting. Tiffany, how are you doing?
I'm good. How are you doing today, Richie?
Good. So let's start out with what is it?
Charitable gifting is essentially when you're giving money to a nonprofit and you are choosing something that aligns with your values or something that you want to see that particular organization be able to meet some of their goals and objectives because you might feel connected to them in one way or another. But typically when we talk about charitable gifting, we are talking about the, federally approved nonprofits, the 501(c)(3)s.
I see. So most of the time we think of doing it in year end. What is actually the best time to do it?
Yeah, so year end, we're often thinking about who we want to give to before December 31st to capture the tax year for any tax deductions. So a lot of people, maybe it's between the holidays, but also for tax purposes, they're looking at year end as a time to charitably gift. But I actually prefer to think about charitable gifting at the beginning of the year.
But why is that? Why would you think about it in the beginning of the year?
Right. So we have maybe just been thinking about all the places that we want to gift to, and maybe coming out of the holidays, thinking about people who might need extra help that might not be as fortunate as we are. And so when we have that mindset of where we want to give, it's a good time to start thinking about how to divide up our charitable gifts that we want to give over the course of the next year. And because I'm a planner and we are planners in our office, I think it's the perfect time to set a budget for the year to say, how much do we have to give? And let's come up with a strategic plan of how we're going to divide that money up between the different organizations we want to give to.
Ah, that makes sense. Okay.
Yeah. And you can reflect on who you gave over the course of the previous year. And if there's anyone you want to, cut out, shift money to a different organization, if there's anyone you want to give to in the new year. But essentially, if you've given to a place once, you're probably going to be on their email list or their mailing list for the rest of your lifetime. And so a lot of people are just, bombarded with organizations that they could give to. And depending on your personality, we have plenty of clients who give a little bit to a lot of different places. And it can be overwhelming when you're getting all of that mail that's pulling at your heartstrings. And if instead at the beginning of the year, you think about who you want to give to, you can be really intentional with your dollars and you can come up with a plan of the places that you think are really going to align the best with your values. Or you can do a little bit of research and say, are they using the charitable dollars they receive in a strategic and smart way? And you can just essentially have a little bit more intention and then feel confident about saying no to the organizations that weren't on your list because they
No.
weren't part of your plan.
So are itemized deductions where you're generally going to get that tax deduction?
That's what most people historically, prior to 2018, did to get a tax advantage from their charitable donations.
Yes.
However, as you probably remember, in 2018, we had a big change up to our tax law, and the standard deduction was pretty much doubled in 2018.
Yes,
So
I remember this. Yeah.
yeah, that itemized deduction is where you take your charitable um, contribution deduction essentially, and everything about the itemized deduction was changed in 2018. So there was suddenly a cap of how much state taxes and personal property taxes could be deducted, and that was capped at 10,000.
Okay.
And then mortgage interest is another area where a lot of people get their itemized deductions from. And a lot of people's mortgage interest is lower than it used to be because of how low the mortgage rates have been over the past decade. A lot of people either got new mortgages or refinanced at these really low.
Especially at that time,
Exactly. So a lot of people has less mortgage interest than they used to. And then the other big hitter for itemized deductions is charitable contributions. Some people also, if you are unfortunate enough to have really high medical expenses, that can be another big item on itemized deductions. But for most people, it's taxes, mortgage interest, and charitable deductions.
Sure. Okay.
Mhm. Now, in 2017, before the change of the tax law,
Yeah.
for single filers, it was about 6,000 for the standard deduction and about 12,000 for married filing joint. And then in 2018, it approximately doubled. Now it's more than that because of inflation. So for 2023, you have to surpass 13, almost 14,000 for a single filer to itemize.
For a
And
single filer? Oh, before itemizing makes sense. And then you
yes,
just take the
exactly.
standard. Oh, I see.
So that standard deduction doubled. And for married couples, it's up to 27, almost 28,000. And it's even more if you're over the age of 65. So you have to have so much in taxes kept at 10,000, mortgage interest, and charitable contributions before you pass that standard deduction. So for most people, they're now just taking the standard deduction. It's great because it's really high, but it is not as incentivizing for charitable contributions. But there are ways we can still make charitable contributions tax advantageous.
Yeah, so
And
that was
so,
my next question. So what are the strategies you can use so that our charitable gifts actually help with the deduction?
yeah, so it kind of depends a little bit on
Mm,
your age and your situation. Let's start with people who are retirees. A lot of our clients are retirees.
mm.
If you're over the age of 70 and a half, then you can actually use your IRA to make charitable contributions.
70 and a half, that's an unusual age, it sounds like.
Yeah, it's actually a weird carryover from the prior RMD rules.
Hmm.
And that's required minimum distributions. That's when the IRS says you have to start withdrawing from your IRA account.
Oh, okay.
And it used to be that you had to start withdrawing from your IRA account the year you turned 70 and a half. And the Secure Act has changed that. And Secure Act 2.0 changed it again. So currently, you don't have to withdraw from your IRA until you're age 73. But the qualified charitable distribution, where you're doing a charitable distribution out of your IRA tax law, is a different part of the tax code. And so they didn't actually update that when they updated the required minimum distribution age. So that actually still remains at 70 and a half.
So is there a limit to how much you can give?
There is a limit. The limit is 100,000 per person per year. So it's a pretty high limit. You have to have a pretty large IRA account to feel comfortable giving that much, most likely.
Yeah,
It's actually per person too. So if husband and spouse, I was
yeah.
trying to be more generic there, but if two spouses have IRA accounts that are pretty sizable, they both could do it.
So you mentioned IRA accounts. Can you do this with 401ks as well?
You actually can't do the qualified charitable distributions with 401ks.
Mm,
Of course, you can always move your 401k or your 403b into an IRA through a direct rollover, and there's no tax consequences to doing that. So if you still have a lot of money sitting in your 401k or 403b, your retirement account through your workplace, and you're no longer working, if this is a strategy you want to use, you can just do a non-taxable transfer to an IRA and then start doing the QCDs.
oh, that's really good information. We did a really good episode about the 401k IRA rollover situation. So that's another reason if you're thinking
Yeah, that
about
was with Tucker, right?
it. Mhm.
Great insights there.
So what is a tax advantage here?
So the money that went into the IRA actually wasn't taxed in most cases. We're talking
Mm,
about a traditional IRA,
yeah,
and we're talking about deductible contributions, which is typically what goes into a traditional IRA. So the money went in was never taxed. The
yeah.
money has grown and has never been taxed. And this is one of the only ways that money can come out of a traditional IRA without being taxed, because when it goes to the charity, um, directly, it cannot go through your hands first. It cannot say, Richie on the check, and then you write it to the charity. It has to
Yeah.
say Richie on the
That makes
check.
sense. Well, that's a
Um,
great option. I mean, that's so good for the charities because I mean, that makes a huge difference in how much they're going to receive. Okay.
exactly. And I think a lot of charities were probably pretty afraid with the change of the tax law and people realizing that they couldn't itemize anymore. It kind
Yeah,
of
you're
disincentivized.
de-incentivizing everyone to do this, right? I was
Ex-
wondering what the effect of that was.
Exactly, but this is a great way for those charities to say, hey, you can still do this in a tax advantaged way. And a lot of places that might have gotten, small trickle amounts over the course of the years, they're saying this is actually better for us because we can budget better when you just give us one large check instead of trickling throughout the year.
So what about those who aren't yet 70 and a half?
Exactly. So we had said it depends on age, right?
Yeah.
So here, if you're not 70 and a half, neither of us are. So a strategy that you could use, Richie, is if you are close to itemizing,
Hmm.
then you could kind of start stacking up your charitable contributions in one year. That standard deduction being high is a good thing. Sometimes we forget it's a good thing, but we want to take advantage of that standard deduction. But in the years that we stack up charitable contributions, we can itemize in that one year. I'm going to give
Oh,
you
I
an
see.
example because I like to use numbers. So say you have the tax deduction meeting the cap of 10,000,
Hmm.
and then you have 15,000 of mortgage interest. So
Sure.
now you're at 25,000. Well, we still have to get to 27,700 before you and your wife can itemize.
Yeah.
So that next like $2,000, $3,000 actually is not going to make any impact. Those first, 2,700 of charitable contributions won't make
Yeah.
impact in this scenario.
Yeah.
But
27,000. Okay. Yeah.
oh, sorry, 2,700. Did I say that wrong?
Oh, it's
2,000.
it's a 2,700. Okay.
Yes, yes. Gosh, I did. I'm confusing because of the way that I'm using these numbers.
Sure.
Back it all up. So the itemized deduction, you are correct, is 27,700
Hmm.
that we have to exceed before we
Yeah.
take itemized deductions because the standard deduction is 27,700. So if you have 25,000 of taxes and mortgage interest, we're still
Yes.
not meeting the standard deduction.
Yeah. So you might at that point just use the standard deduction.
Exactly.
Okay.
Now, if it's your norm to give like 5,000 per year to charities and you want it to make an impact, well, only a portion of that $5,000 is going to cross over that threshold.
Sure.
But say you are able to front load it, do like 4 years worth of charitable contributions, you can then have almost all of that be tax deductible and then say for the next 3 years, not try to itemize at all and just take that high standard deduction. So
Yeah.
this is one way by front loading, putting it all in one year, we can really take advantage of having those charitable contributions be tax deductible.
Also, these charities are probably getting larger checks just less frequently.
Yes,
People are
it
using
could
that
be that
strategy.
way. Could be that way, or you can actually leverage something called a donor advised fund.
Oh, okay. What
This
is a
is
donor advised fund?
Yeah, so this is an account that you can set up. Um, Most institutions are structured now where you can set up donor advised funds with them. We do it most often at Schwab or Fidelity, and those are two of the lowest cost options for
Hmm.
setting up these donor advised funds. They also have really low minimums, so they're great places to set up these donor advised funds. But it's essentially an account that you set up that has a charitable intent. So you put money into it, say that one year where you're really front loading your contributions. The
Yeah.
year you put money into the donor advised fund is the year you get your tax deduction. And then the money can sit in that fund and be distributed over the course of many years if you want. So you can,
Oh, I see. Oh, that's
yeah.
good.
So you can still give to the charity over those next 4 years in our example. And the money can actually be invested and grow. And so you might, be really strategic and be able to give even more than you initially put into the funds. But it
Okay.
allows you to still get that tax advantage of itemizing and then really take advantage of the high standard deduction. You'll be better off in this situation than you used to be for tax purposes because we didn't have such a high standard deduction. You're kind of getting to take advantage of both of the tax benefits here.
Yes, that's right. You do get advantage of using both. You just have to
Mhm.
wait that initial period and then it's just happening. Oh, that's great. Okay, that sounds like a great strategy, but what if you don't have that much sitting around?
You don't just have, 20,000 of spare cash you're going to give up.
Oh, you don't? Oh, okay.
No. So most people don't have that much cash
Yeah,
just
right.
sitting around. But the great thing about donor advised funds is you can actually contribute things other than cash. Highly
Oh,
appreciated assets are a great resource to move into donor advised funds.
that's awesome. Definitely did not know that at all.
Yeah, so the easiest one to think about is a highly appreciated stock. If you're fortunate enough to have purchased NVIDIA at the beginning of this year,
Oh,
or
yeah, right.
if had that Tesla investment that really shot up, or if you were gifted Disney or Apple 30 years ago, those would
Hmm.
all be really highly appreciated stocks. But
Oh,
essentially, if you're looking at your portfolio and you have any stocks or mutual funds or anything that has grown a lot, when you sell that fund, you're going to have to pay taxes on that capital gains.
of course. Yeah.
But say you purchased it for 100, it's now worth 1,000, and you move it into a donor advised fund, you get to take the full $1,000 as a charitable deduction and not pay any of those capital gain taxes.
That's great.
Yeah, you avoid the capital gains and you get the tax benefit of a deduction for the charitable contribution. So the highly appreciated stocks are a great option for moving into donor advised funds. And even if you don't have a donor advised fund account, highly appreciated stocks is a good resource for making your charitable donations.
So, what are the other advantages of using these strategies?
So kind of what I referenced before of budgeting for the year. I think it really makes a lot of sense to be intentional with your spending. We create intention with spending in all areas of our financial lives, and charitable spending should be one of those. I think if you're being intentional, you're giving to the places you want to give to, and you can look into the charitable organizations and see if they're spending the funds the way that you want them spent. You may or may not feel good about having large cash reserves that they're maintaining, or you may not feel great if they have extremely high salaries for
Mm.
the head honchos of the charitable organizations. And there's easy ways you can look into all of this and do a little bit of homework so that you can feel really good about your charitable contributions.
So, what are some of the ways you can look deeper and to see how charities use these funds?
Yeah, so I actually have found some really great resources that I like to use that are free and available online. My favorite is called charitynavigator.org, and you
Hmm.
can search any organization. They have so many, even local organizations that are listed on there that they've done the homework for you. Essentially, every charity that brings in over $50,000 has to file a tax return with the IRS called a 990, but they do the work and they look at all of these 990s and they compile the information and give a simple rating, like 4 stars, and a 95% rating. So they'll give a simple rating that you can look at and say, okay, they've done the homework and they approve of this charity. And then you can actually dig deeper into the report if there's areas that you really care about and see, oh, they're doing a great job with their leadership, or they're spending, the high majority of their money on what they say they're spending it on. You can dig a little deeper if that, is important to you. There are other websites, I should say, that also have similar homework and data gathering if you kind of want to cross check. I have not found some of these other ones to be quite as robust in going to some of the smaller local nonprofits,
That
but
makes sense.
we've got charitywatch.org,
Okay.
give.org, and givewell.org. All do the same type of thing.
But the first one in Navigator, Charity Navigator does have data on the more local
charitynavigator.org.
ones.
Yeah,
Yeah, that's really important, especially if you really want to give locally to have that data available
mhm,
because you don't know what's going on otherwise. Okay.
exactly. And all of these websites also give you some good information of what to look for and consider if they haven't already rated a nonprofit that you want to look at. Um,
Oh, that's helpful. Okay.
Yeah, it tells you, where to go and what to look into, to help evaluate for yourself.
So are there any other strategies that work?
Yeah, there are plenty of other strategies. A lot of them can get more complicated and are for more unique cases.
Mm,
There's charitable trusts that you can use. I really like these strategies that I've named here today because they are widely applicable and inexpensive to implement.
mm,
For the qualified charitable distributions out of your IRA, you should be able to go to your financial advisor, or if you don't have a financial advisor, the custodian or institution that holds your funds, and they should be able to process the qualified charitable distribution at no to very low cost. That's a great resource and it's very inexpensive to do. It's become so much more common these last 5 years that most organizations should have a great procedure in place for how to process these. I've seen some smaller banks have a little bit of hiccups when it comes to those qualified charitable distributions. You really need to make sure that it goes straight to the charity.
okay.
But it's inexpensive to do that. And those donor advised funds, they can have a little bit more cost. The account can have a minimum to set up or cost to maintain the funds in the account, but those costs are, at most of these places, like I named Schwab and Fidelity, those are very low cost to have these types of funds in place. Um, Vanguard is known for having, really low cost options as well. Their minimums aren't quite as low and their expense ratio is slightly higher for these donor advised funds. So Schwab and Fidelity are my two top picks, but Vanguard would be a good third option.
Well, great. Well, I know I learned a lot during this episode. So, Tiffany, thanks for coming on the show. We hope to see you soon, and I'll take it easy.
Thank you so much, Richie. It's been my pleasure. Thank you for having me.
You're welcome. All right.